Hello dear traders. Today we're going to take a look at the grid trading strategy, so make sure to subscribe and stay with us until the end. What is grid trading? Grid trading is a trading strategy where a number of pending buy and sell orders are placed at predetermined price intervals above and below the current market price. The goal of this strategy is to profit from price fluctuations within a specific range, without needing to predict the market direction. How it works. 1. Define the price range. The trader first sets a price range in which they expect the price to fluctuate. 2. Create the grid. Inside this range, multiple horizontal price lines are drawn at equal intervals or custom intervals based on the strategy. These lines are called the grid. 3. Place the orders. Above the current price and on the grid lines, pending sell orders or sell limit or sell stop are placed. Below the current price and on the grid lines, pending buy orders or buy limit or buy stop are placed. 4. Trade execution. As the price moves and reaches each grid level, the corresponding pending order is activated and opens a trade. 5. Set take profit and stop loss. You can set a take profit and stop loss for each trade. Usually, the take profit is small and placed at or near the next grid level. Types of grid strategies. 1. Simple grid. Orders with fixed volume are placed at all grid levels. 2. Martingale grid. After each loss, the next order in the same direction is doubled in volume to recover the loss. This method is very risky. 3. Anti-Martingale grid. After each profit, the next order in the same direction increases in volume. 4. Adaptive grid. The spacing between grid levels or order volumes are adjusted based on market conditions. Advantages of grid trading. 1. Potential profit in ranging markets. This strategy works well in markets that fluctuate within a defined range. 2. No need to predict market direction. The trader profits from price swings in both directions. 3. Can be automated. This strategy can be automated using trading bots. 4. Potential risk management. If used properly, with proper grid spacing and order sizing, risk can be managed effectively. Disadvantages of grid trading. 1. High risk in strong trends. If the price continuously moves in one direction and exits the grid range, it can cause significant losses. 2. Increased number of open trades. Activating many orders can lead to a high number of open positions and require a large amount of capital. 3. Trading costs. With many trades, commissions can add up quickly. 4. Requires precise setup. Defining the price range, grid spacing, and order size requires analysis and experience. 5. Margin call risk in leverage trading. In leverage trading, sharp price movements against your position can lead to a margin call. Key tips for using the grid strategy. 1. Set a stop loss for the entire grid. To protect your capital if the price moves out of the expected range, it's essential to set an overall stop loss for the whole grid. 2. Proper capital management. Each order's volume should be set so that even if all grid orders are triggered, the overall risk remains manageable. 3. Choose the right currency pair or asset. This strategy is better suited for assets with moderate volatility and without strong trends. 4. Test and optimize. Before using it on a real account, test the grid strategy on a demo account and optimize its parameters. Due to the complexity and risks involved, grid trading requires knowledge, experience, and precise risk management. Be sure to research thoroughly and understand the risks before using this method. To learn more about different trading strategies, subscribe to our channel and feel free to ask any questions in the comments. Let me know if you want this formatted for a blog, video script, or anything else.